Hello, everybody. Welcome to today's coaching webinar. I think this is our first coaching webinar for 2010. Yay! Happy New Year, everybody! And I'm excited to be on the line with you today. And I want to thank you and appreciate you for being on here. Let me say hi to you guys. Hey, Art, Happy New Year. Hey, Joe. Hey, John Hamfling and John Witherspoon. Hello, Joseph. Hello, Julio. Hello, Kenneth. Hello, Kevin. Hello, Maria. Hello, Mona. Hello, Neil. Hello, Richard. Hello, Sam. Welcome, guys. Let me see here. Neil said, it's my birthday today. Awesome, Neil. Well, happy birthday to you, buddy. And I see Ronald coming on as well. You can hear me, Ronald. Hello. Happy New Year to you guys. I hope you guys are doing good. What the topic we're going to talk about today is owner financing, and more specifically, owner financing with this $8,000 grant program that we are doing. Okay, and so that's the topic that we're going to go over today. For those of you who missed the last coaching webinar's topic, that was the real estate investing quick start. So, if you don't know if you don't know the basic of real estate investing, you might want to watch the replay on that. And I have Jersham on the line with us to share with you that replay if you need that, and we'll send that replay out as well to all of you. But it should be in the Dudios University area for you to access. Okay. All right. So so we'll get started here. Real quick, I want to go over the overview of what owner financing is, and we'll drill down more specifically here. Okay. There are many types and many, I guess, many forms of owner financing. The most common form of owner financing is the kind where the seller owns the house free and clear, okay, and you buy from that seller and they finance it to you. So they act as a bank. They act as a bank, and each month you pay them. You pay them your mortgage, okay. Each month you pay them your mortgage, and they keep the money, okay. So they act as a bank. So that is that is what the normal owner financing, most of you know, is. And then there's also a wraparound mortgage. It's another type of owner financing. Subject to is a type of owner financing. Contract for deed, land contract, or what's another term that let me see. Contract for deed, land contract. There's another term that that relates to contract for deed or land contract, which is also the same type. There's lease option is another type of owner financing. Lease purchase, another type of owner financing. Rent to own is another type of owner financing. So all of these are all different types of owner financing. Okay, and I'm going to go in and explain to you guys a little bit on how they are different. Okay, how each of these are different. All right, let me go over here. In a straight owner financing, and when I say straight owner financing, that's like that normal owner financing that you normally hear about, or that you are familiar with, or might have heard about it before. And like I said earlier, what happens is that what happened in the transaction is the seller deeds the house to the buyer. Okay, so when the buyer buys the house, the seller deeds the house to the buyer right away, and the seller acts as a bank. And the buyer is going to sign a deed of trust or a mortgage, depending on the state that you're in. And basically that document, that deed of trust or that mortgage is the buyer saying, I'll use the house as a collateral, and if I don't pay, you can foreclose on me and get the house back. Okay, and the in most straight owner financing or normal owner financing, the seller owns the house free and clear, or if they do owe money, if they do currently owed money on the house, they would pay for it, pay for all of it off at the time of closing, so that way after closing the seller owns the house free and clear. So there's no existing mortgage or liens on the property. Okay, the seller just owns it free and clear. And each month the buyer pays to the seller, and if the buyer doesn't pay, the seller forecloses on the house and get the house back. Okay, so that is a an owner financing. When I say straight, that could also mean normal. So let me just make a note here to say normal. Understand that, all right? So you guys all understand that pretty well, right? Joe asks, is this mind map available? Currently, it's not, but I will send this over to Joshua, and he'll upload it and put it into I guess where you'll be watching the replay. You can download this. So in the members area or the Due Deals University area. Okay, so where was I? Yeah, so so this is the normal owner financing, pretty straightforward stuff. Okay, I'm probably not going to have to go through too much in detail about that. The next type of owner financing is a wraparound mortgage. And what a wraparound mortgage is that it's very similar to a normal owner financing. The difference now is that the seller does own money on the house. They do have an existing mortgage on the property. Okay, they do have an existing mortgage on the property. So, so I'll give you an example here. Let's say the house is worth $100,000, and the seller still owed $80,000 on the house. Okay, and the seller will do a wraparound owner financing to the buyer for $100,000. So what that means is that the buyer owes money to the seller, $100,000 for that house, and the seller owes money to their bank, $80,000 on that house. Okay, so that's what a wraparound mortgage is, and here's how that works. The seller is going to deed the house to the buyer. Seller's going to deed the house to the buyer, and the seller acts as a bank. The buyer is going to sign a deed of trust or a mortgage to the seller, and basically using the house as a collateral, just like a normal owner financing. And here's how it's different: is that the seller keeps the existing loan or debt on the property. Okay, the seller keeps the existing loan or debt on the property, so that's why it's called a wrap-around mortgage. They're creating a second mortgage that wraps around the existing first mortgage that they have on the property with the seller. Okay, and let me see here, and then each month the buyer pays to the seller and the seller pays to the bank. So each month the buyer pays to the seller and the seller pays to the bank. And if the buyer don't pay, the seller can foreclose and get the house back. If the buyer don't pay, the seller can foreclose and get the house back. So I'll give you so it's the same example, and let's say the seller owes to their bank $800 a month, and the buyer owes to the seller $1,000 a month. So each month, okay, each month each month the seller is getting a $200 a month spread, or a month's cash flow, from the difference between what the buyer is paying them and what they have to pay to the bank. Okay? And then another type of owner financing is called subject to existing financing. Some of you might have heard about this before. And hold on here, Richard has a question, so let me answer that for him real quick before I move on. If the seller doesn't pay to the bank, okay. Well, if the seller doesn't pay to the bank, then then the buyer kind of get locked out, and the buyer would have to sue the seller for that. Now, there are ways that we can structure the documents to give the buyer more protection, such as using a loan servicing company. So that way, instead of the buyer paying to the seller each month, the buyer can pay to the loan servicing company, and then the loan servicing company will use some of that money to pay for the seller's mortgage, and then the rest send it to the seller. But loan servicing company costs money, and so that's a big reason why a lot of sellers don't want to use a loan servicing company. You can also create the deed of trust in a way that if the seller miss a payment, if the seller is 30 days late on their mortgage, that the buyer can then have the right to pay directly to the mortgage company, and the seller would owe the buyer whatever money that they paid to the seller that the seller did not pay to the mortgage company. So so those are a couple of things that we can do to protect the buyer. Okay. All right. So let's go to a subject to financing here. A subject to financing is very similar to a loan assumption, except for it's a non-qualifying, non-approved, non-approved loan assumption. What that means is this: a loan assumption is when, and this used to be very popular, back in the 80s, where if you have an FHA loan or a VA loan, that your buyer can assume that loan non-qualifying. So let's say you have a house and you owed $80,000 on it. Whatever buyer you find, they can just take over that mortgage and start making payments on it, and they don't have to qualify for that loan. Okay, so that's a loan assumption, and now we don't have non-qualified loan assumptions anymore. You still can assume loans, but the bank will make you qualify for it. So they'll check your credit and your income and all of that stuff, just as if you were getting a new loan. Okay, so you still can assume loans, just it's not non-qualified. And a subject to is where you take over the existing mortgage, but you don't ask the bank's permission for it. So it's like assuming a loan, but you don't ask the bank's permission for it, because they won't give you permission for it in most cases, unless it's like some local banks that's willing to work with that. But in most cases, the banks won't allow you to. To assume those loans or to take over subject to. So they have this due on sale clause that that protects them with that. So that way, if you change, anytime a seller transfer the ownership of the property, anytime the seller transfer the ownership of the property, that the bank has the right to call the loan due, meaning to foreclose on the property and get the property back. But they have the right to do so, not the obligation to do so. And in most cases, they do not do that, especially if the mortgage payment have been made on time. I have heard of cases that they have done it, but it's very rare, and it never has happened to me yet. Okay, I had a case where the seller, after our transaction, faxed into there was 2 loans on the house. One was from Chase, one was from Bank One. This is before Chase bought over Bank One, and the seller faxed all of my documents over to their banks, including the trust agreement, the power of attorney, all of that stuff, and says, okay, I've already sold my house to this guy. He's going to be the one that's going to make the mortgage payments from now on. And their banks just said, okay. That was it. Okay, so banks are not in the business of foreclosing on properties. They're in the business of loaning money, so as long as the payments are made on time, they'll be pretty happy. Okay. All right, and so what happens in a subject to is that the seller deeds the house to the buyer, and the seller keeps the existing loan or debt on the property, and the loan stays under the seller's name. Okay, the loan stays under the seller's name. What that means is that what that means is that if the seller is liable for the repayment of the loan. So if the buyer doesn't make mortgage payment on that loan, it's the seller's credit that's going to be affected by it. Okay, and then each month what happens is the buyer pays directly to the bank. So the seller, other than the loan stays under the seller's name, they no longer own the property. Okay, they no longer own the property, and so because of that, if the buyer don't pay, then the bank can foreclose on the house and get it back, but the seller cannot foreclose on the house and get it back like they can with a normal owner financing or wraparound mortgage. Okay. Now you might ask, well, why would a seller agree to such a thing? Why would a seller agree to let you take over their house subject to and keep the loan under their name, and if you don't pay, it hurts their credit? And the answer to that is that what other choice do they have? You see a lot of sellers who accept these type of transaction, these subject to transaction. A lot of them are in pre-foreclosure or getting ready to get into pre-foreclosure, getting ready to lose their house, and because of that, because of that, they're pretty desperate. They just want to do whatever it takes to get their house sold, because they understand that if they put their house on the market on the MLS, they might not sell it in time before they lose their house, or that they can't afford to pay real estate agent commission plus all the closing costs and all of that stuff, because they probably owed a lot of money on the house. So, let's say I'll give you an obvious example here. Let's say the house is worth $100,000, and the seller owes $100,000 on it. So that means that if the seller tries to sell the house to the retail market after real estate commission and closing costs and everything, the seller might end up having to pay out of pocket at closing $10,000 to $15,000 to make that deal work. Okay, and so because they don't have other options, therefore they would be willing to take a chance on the buyer making the payments on time. Because the way the seller looks at it is that I can either go ahead and miss my payments now and get into foreclosure and ruin my credit now, or I can take a chance on this buyer, and if this buyer does what he says he's gonna do and make my payments in time, that means that my credit will be saved, and I won't have a foreclosure on my credit anymore. So to the seller, it's a matter of, okay, do I want to get a foreclosure now or take a chance on this buyer and maybe get a foreclosure on my credit later on, or maybe never? Okay. So that's subject to existing and financing. You guys have any question on that before I move on? Okay, I want to make sure that you guys understand these owner financing stuff really well, because it's one of the biggest questions we get all the time. Is how do you do these owner financing deals, or what are these owner financing? Okay. All right. The next type of owner financing is it's called a land contract or a contract for deed. Different area, different state calls it differently, but but they all mean the same thing. Okay, and what a land contract and a contract for deed is that it's similar to a it's similar to a normal owner financing or even a wraparound mortgage owner financing. And let me see here. Adjust this so that way you guys can see it better. It's very similar to an owner financing. Here's where it's different. Okay, the difference is that instead of the seller deeding the house to the buyer at closing, is that the seller is going to sign a land contract or a contract for deed with the buyer at closing. And basically, the contract for deed says that that the buyer has a contract to buy this house, and when the buyer finished making all of the payments, then the buyer will get the deed to the property. Okay, the buyer will get the deed to the property, and then if the seller owns the property free and clear, then that stays the same. Or the seller, if they have an existing loan on it, they can choose to keep their existing loan on the property, just like a wraparound mortgage. And anytime you keep an existing loan on the mortgage, on the property, you run into the risk of due on sale clause. Okay, and then each month the buyer pays to the seller, and if the seller owes any money to their bank, then of course they would pay to their bank. Okay, and if the buyer don't pay, the seller can foreclose on the property and get the house back. And the buyer does not get the deed until the buyer finishes paying for the house. Okay, this is a land contract or a contract for deed. And contract for deed is not favorable in all states. It's favorable in most states, but not in all states. Like here in Texas, contract for deed is not favorable, and so that's why we don't sell on contract for deed. You can sell on contract for deed to an investor buyer, but not to an owner-occupant buyer here in Texas. And so that's why here in Texas we use wraparound mortgage a lot, and not as much, not as much contract for deed. Okay. All right. I hope you guys understood that one. And then the next type of owner financing is called the lease purchase or lease option or rent to own. Okay, and lease, even though these terms, these lease option, lease purchase, rent to own, they have slightly different meaning. A lot of people just use them interchangeably. Okay, a lease purchase and a rent to own is much more similar to a land contract and a contract for deed. A lease option is something that's different. A lease option is basically a lease with an option to buy the property, and a lease purchase and a rent to own is a lease with a contract to buy the property. Okay, but you guys don't need to know those details, because most of the time when you hear lease option, lease purchase, rent to own, when you hear them talk, people tend to use them all as the same thing, even though the technicality of it is different. Okay. Let me see here. Kevin asked, in a contract for deed, who pays for the property taxes? The buyer living in the property or the seller? In a contract for deed, the buyer is responsible for everything in the house, just like a normal buyer. The only thing that's different is that they don't get the deed to the property until they finish paying for it. If you think about your car loan, it's very similar to a car loan. Right? You are still responsible to buy insurance on the car. You're still responsible to pay for any taxes on the car. Whatever you have that's on the car, maintenance of the car, you're responsible for all of that. You don't get the title to the car until you finish paying for it. So a contract for deed on a house is just like that. The buyer is responsible for all the taxes, insurance, maintenance, repairs, whatever goes on in the house. The buyer is responsible for that. Okay. All right. So in a lease option, lease purchase, rent to own, what happens is the seller rents the house to the buyer. The seller gives the buyer the option or the right to buy the property at a later time if the buyer wants to. If the buyer don't want to exercise their option, they can always back out of the deal. Okay. They can always terminate that option. And the seller, the seller keeps the existing loan on the property if there's any. Just like in a wraparound mortgage, if there's an existing loan, they can keep it, and of course, if they keep it, so the seller can keep it. They can also, it's possible that the seller doesn't owe any money on the house, so they own it free and clear as well. And each month, the buyer pays the seller in the form of a rent. Okay. Unlike here with owner financing and wraparound mortgage and subject to and contract, where the buyer is paying it as a mortgage, here on the lease option, lease purchase, rent to own, the buyer is paying it as a rent, not a mortgage. So there's no principal. It's not principal and interest. It's just rent. If the buyer don't pay, the seller can evict the buyer out of the house and get the house back. Okay, so in this case, the seller doesn't have to foreclose on the property to get it back. They can evict to get it back. And the buyer does not get the deed to the property until the buyer is ready to exercise their option and buy the house. Okay, so if the buyer never buys the house, then they'll never get the deed to the property. Okay. Okay, and so let's do that. I used to teach a lot about doing delayed closing contract, which is where you have a lease and an option. But because of the $8,000 tax credit that we have now, I don't recommend for you to do delayed closing contract. I'd much rather for you to do the wraparound mortgage, so that way the buyer can qualify. The buyer can qualify for the $8,000 grant from the IRS. Okay, so that's it about owner financing. You guys have any questions regarding that? Most of the time when I close on owner financing deals, I close at my title company, and so they are the one that prepare all of the paperwork that's needed to do owner financing. So you don't need to, and it's best if you don't. Close these deals, on your own. It's best if you go through a title company and close them at a title company, so that way the buyer can get title insurance and all of that good stuff. And the title company will prepare all of the paperwork. Okay. The only exception to this would be the lease option, the lease purchase, and rent to own. For those type of deals, I normally close them on my own without going through a title company. Okay. John, you raised your hand. Is that because you have a question? Can you type in your question for me? Okay. Let me see here. All right, so next let's move on to this $8,000 grant program. This $8,000 grant program, or sometimes you've heard it called as the $8,000 tax credit or the $8,000 rebate. And what it is that the government, the IRS, says that for any first-time home buyers who haven't bought a property to live in, okay, an owner-occupant property to live in the last 3 years, then they can qualify for up to $8,000. They qualify for 10% of the purchase price, up to $8,000. And in our case, most if not all of our deals are over $80,000. So we almost always get the $8,000 tax credit and not anything less than that. Okay, and then there's also up to $6,500 for second-time home buyers. And second-time home buyers is defined as someone who had lived in a home that they live in a home that they own at least 5 of the last 8 years. Okay, so if you had lived in a home that you own for 5 of the last 8 years, then you can also qualify for for the up to $6,500. So even if you had bought even if you had bought a property in the last 3 years, but you have lived in an owner-occupant property before that, at least 5 of the last 8 years, then you can also qualify. You can also qualify for a up to $6,500. Okay, and what the IRS require of you to get this $8,000 tax credit or grant money is they require the buyer to have a state ID. Okay, for each of the if it's a couple, for both parties, they require the I guess now that we're in 2009 here, they require the 2009 tax return. But you can also go back to 2008 and amend the 2008 tax return as well. Okay, so the government let you go back to 2008 as well, and then of course you also need the cashier's check from the buyer for any closing that they might have to put down. Okay, and then from you, what you need to get is you need to get a sales contract with your buyer. And when I say you, I mean you as the seller or the seller from the seller. Okay, I'll just put from the seller, so that way you understand that. Okay. The seller needs to have a contract with the buyer with a seller financing addendum, an addendum for the $8,000 tax credit. The seller has to also provide the buyer with all of the disclosures, like the lead-based disclosure. If there's here in Texas, if the home was built in 1978 or older, you have to give lead-based paint addendum. Any homeowner association disclosure, or property disclosure. So you have to provide those kind of disclosures to the seller, to the buyer. The seller also needs a limited power of attorney from the buyer. In this case, the seller is you. Okay, so you would also need the power of attorney from the buyer, so that way you can endorse the check later, and gives you the right to sign documents for the buyer, basically. And you also need the power of attorney that's an IRS form 2848. So IRS has their own power of attorney form that they want you to use if you're going to be submitting or if you're going to have your CPA submit the paperwork for the buyer to amend the taxes or to file the tax returns. And then at the closing, you also need to have insurance from the seller showing the buyer as a lost payee or additional insurer. So basically, adding the buyer's name to the insurance policy. Okay, and you also need a CYA letter to explain to the buyer that that this $8,000 tax credit is going to come to you, and it's going to be used as part of the down payment on the house. That they must live in the house for 3 years, because if they don't live in the house for 3 years, or they default on their mortgage and get foreclosed on, they are going to owe this $8,000 to the IRS. Okay, so they must stay in the house for 3 years. And then after closing, you forward the IRS form 2848, the buyer's W-2 forms, a copy of the HUD-1 settlement statement, and the buyer's ID, along with the property address to the CPA, and it could be your CPA that knows how to file for these $8,000 tax credit, or you can use the CPA that Stan and I have set up for you to for you to use with these $8,000 tax credit. Okay, and the CPA will charge you. Our CPA charge like I think $125 or something a file, very inexpensively. And the way they do it, is that they do a temporary change of address. So the check goes to the CPA. It does not go to the buyer. It goes to the CPA, and the CPA will the CPA will then send that check over to you, and then you just endorse that check as the buyer, deposit into your bank account. If your bank won't, if you have a bank that won't allow you to deposit someone else's check into your business account, what you can do is you can set up another bank account that you can put the buyer in on that bank account as a additional signer on the on that bank account, and then with the buyer's name being on that same bank account, you can then deposit that check, and as soon as the check clears, you can call the bank and remove the buyer from that bank account. So you can also do that as well. Okay. And let me see here. So any question there? See. Let me see. Kevin said, the second-time home buyer, does a person who currently owns his own home qualify as long as he's lived in it for at least 5 of the last 8 years? The answer is yes. That is correct, Kevin. Okay. Let me see here. All right. So next, let's move on to how can you buy and sell these owner financing deals. Okay. Let me go here. The first thing first in buying and selling these owner financing deals is is identifying the neighborhood that has the best type of these deals for you. And typically speaking, neighborhoods that are about 20 to 40% less than what the your median home prices are is good for these type of deals. For example, let's say here in Houston, our median home price is $150,000, and so homes that are between $90,000 or even $80,000 to $125,000 is it's ideal for these type of deals. Okay, and neighborhoods that has a lot of foreclosures is also good for you because you'll find a lot of motivated sellers that are upside down on the property, and so you have more sellers that would be willing to do owner financing. Okay, and then neighborhood with with hardworking blue collar type workers are great because those buyers, a lot of times they have dings on their credit or they don't have any credit, and so by you offering them owner financing, they love it. Okay, and they make great buyer for these type of deals. And on these type of deals, we don't care as much about the buyer's credit as we care about their income. So so if the buyer is making 3 times more than what the what their mortgage payment is, so let's say their mortgage payment is $1,000 a month, and and they're making $3,000 a month, then they have potential for this house, assuming they don't have too many other debts. Assuming they don't have too many other debts, and so we try to keep the debt to income ratio down to be about 1/3. Okay, which is what the third would be 33% or so, And that's how we qualify these buyers. So it's more income dependent than it is credit dependent. Okay, and neighborhoods that has around 50 to 70% owner-occupant properties, owner-occupant houses, those make good neighborhoods for these types of deals. Okay, and so first thing first is the marketing of the property. Let me see here. Hold on here. Judy has a question, so let me answer that before I move on here. Would a bank take a cosigner's name off an account without a cosigner's written consent? No, a bank would not take a cosigner off of a bank of an account. At least I don't think so. Okay. Unless you're talking about what I was talking about, not a cosigner. You're talking about like just sort of like an additional person on the account. The answer is yes. You have the primary account holder, and then you have the secondary, I guess. The people just have the name on it, and for the secondary name on the accounts, the bank will remove their name off of the bank account without their consent, yes, without their permission, because you as the primary account holder, the person who opened up the account, you were the one that added them to the account, and so you can remove them anytime you want. Okay. All right. Yeah, I misunderstood what you meant by cosigner. I thought you meant cosigner as in like, somebody co-sign a loan for you. All right, Ronald asks, can you do your own HUD-1 without a title company or attorney? The answer is yes, you can. However, they recently updated the HUD-1 settlement statement now, and so it's a little bit more complicated than that. But the answer is yes. You can do that. However, I recommend that you close all of these deals at the title company. I don't recommend that you close them on your own. Okay. All right, Neil asked, could you use a PayPal account, or do you have to have a bank account, or could I use a bank account here in what's OZ? Where's that? Is that Australia? Oh, okay. No, I don't think you can use a PayPal account. And if you're trying to do these type of deals here in the U.S., you would need to have an account here in the U.S. to deposit that check. Or if you have someone here that can deposit the check for you and send you the amount. For example, let's say you're doing this deal with us, okay, with Stan and I. Then we would deposit this account into an account that Stan would open up, and then he would PayPal you whatever your part of the deal is. Okay. But if you're going to if you're going to do real estate deals on your own, then you should open up a U.S. account. Okay. Kevin said, I'm still confused about the $8,000 check. It goes to the attorney, then the attorney gives it to you. Isn't it supposed to go from the IRS to the homeowner? Kevin, the $8,000 check goes to the CPA. Here's what happened. When the CPA files the tax return for the buyer, which is the new homeowner, the CPA does a temporary change of address. And so because of that temporary change of address, the IRS sends the check to the CPA from that temporary change of address. It's still under the buyer's name, but it's sent to the CPA. and you can endorse that check because you have a power of attorney for the buyer. Okay, I hope that clears it up. All right, so we'll move on now. All right, so how to buy and sell these owner financing deals? So once you identify the potential neighborhood, the first step is to start marketing for for buyers or sellers. It really doesn't matter which one you do first, or you do both of them at the same time. If you can start marketing for buyers if you know where that neighborhood's going to be, okay? What we do is we pick a neighborhood, okay? What we do is we pick a neighborhood and we put out a bunch of blank signs for that neighborhood. So we start building our buyers list, and then from there we find sellers in that neighborhood. And so you can do it that way, or you can first work on the seller, and and then market in that neighborhood. Okay, so this is kind of up to you, and here's why. If you are okay with calling sellers now, okay, if you don't need, because some people, what happen is that they get scared on calling sellers because they're afraid that they might not find a buyer, and so this is the reason why I put buyers marketing first here. But if you're not afraid to call sellers, then you certainly can market to find the sellers first, and then once you have the seller, you can then market to find a buyer for that neighborhood. Okay, so you can move these things around depending on you. I put the buyers first to help boost up your confidence. Once you have phone coming in from your phone calls coming in from your buyers, that it will give you the confidence you need to give you the confidence that you need to call on sellers to do your real estate business. But to do your real estate business, and so that's why I put buyers first. I see a couple more questions from the $8,000 tax credit. I wanted to answer all of these tax credit questions, so that way we don't have to come back to it later. All right, how fast do you expect the $8,000 check from the IRS? If the buyer has not filed for the 2009 taxes, and the CPA can do an electronic filing, then it can take 10 days for you to get your check, or you can even have it deposit directly into the bank account, like electronic deposit. If the buyer, if the buyer had already filed for their taxes and you have to amend their taxes, and assuming they filed paperwork-wise, then it would take 4 to 6 weeks before you get your check. And if it takes any longer than that, the IRS will pay you interest on that $8,000 tax credit. So you end up with a check that's more than $8,000. That's because the IRS is paying you interest for taking a long time to send a check to you. And so in this case, how it's beginning of the year now, most buyers have not filed for their taxes yet. So this is the best time to do it. And most likely, since they haven't filed for their taxes, that your CPA will be able to do an electronic filing, so you'll be able to get your $8,000 check much quicker. Okay. Richard said, so we all have the option to do these deals as your JV partner as a part of this program. The answer is yes. That is correct. Okay. see here. Neil said, Neil said, in Texas, what kind of rules, laws do they have against real estate signs? Well, yeah, it depends on the city. But most cities don't allow you to put out signs in public places unless you have permit for them. And and so what we do a lot of time when we put out signs is we put them out on vacant houses, okay, because that's private properties. Richard said, I missed the last webinar and they said it wasn't recorded, so I'm just trying to fill in the blanks. Yeah, the last webinar was recorded, Richard, so Jersham will give you the replay for that, okay? It's because all of my staff were out that day, and so I was the one that recorded it. Okay, let me see here. Art said, can you explain the best method of online marketing for buyers? We'll talk about that in just a little bit here. And Kevin said, why would the buyer need to amend the 2009 taxes? The buyer is buying a house in 2010. Well, if they have filed for the 2009 taxes already, then they would amend the 2009 taxes. Okay, we're in 2010, but you know when you file for your taxes this year, and you have up until April 15th to do it. When you file for your taxes, you're filing for your 2009 taxes. And so if you had already done that, then you have to go back and amend it. Most buyers right now have not done it because we're only like the 5th day into the year. Most people haven't even gotten their W-2 yet. Okay. All right, so let's talk about marketing for sellers here. Different ways you can market for sellers. You can market for them offline, like driving for dollars. Okay, driving for dollars, where you're driving a neighborhood looking for sell by owners, for rent by owners, or expired listings. That a real estate agent can give you a list of expired listings. You can find the phone number for those buyers, or send them a direct mail. Okay. You can go after landlords, especially landlords with eviction notices. But generally speaking, you can just go after landlords in general. You can also you can also just log into dodeals.com members area. Okay, log into dodeals.com members area and call on sellers. Call on motivated sellers, call on owner financing sellers, call on landlords. Okay, you can also use the instant lead generator as well, which is also in the Due Deals members area. Okay, to call on sellers that have ads. Okay, let me see. Here, landlord would notice eviction notice. Okay. Yeah, and then you can also contact any non-owner occupant homeowners. All right, so you can get a list of non-owner occupant homeowners in a neighborhood and do a direct mail or track down their phone number and call them as well. Okay. And you can also use you can also use signs to put on vacant houses, like I buy houses sign with your phone number on it to attract sellers. Okay, or like a stop foreclosure sign in front of a seller's in front of vacant houses in that neighborhood to attract sellers. So you can also do that. You can also use the instant lead generator to send out emails for them as well. Okay, you can do direct mail campaign to the direct mail campaign to contact them. Okay, and then the most important thing is once you contact them is follow up. Okay, it's follow up. Once you talk to them and they say yes, I agree to do your flex option, then make sure you just keep on following up with them. Keep on following up with them until they until they do sign the flex option and give it back to you, and then from there you can and then from there you can start marketing their property to find buyers, which is our step number 2 here, is to market to find buyers. Okay, and the type of buyers that we're looking for is we want buyers that can qualify for the $8,000 tax credit. Those are our best buyers for these types of deals. Let me see here. Kenneth asked, where do you get the list of sellers? If you're talking about like buying lists, you can buy them from InfoUSA or RealQuest. There's a lot of different companies out there that will sell these non-owner occupant buyers that you can buy from. Okay, so InfoUSA or RealQuest.com. But the easiest for you to first start out is just these 2 things right here. That's the easiest ones. So just logging into dodeals.com, contact the seller leads, contact the landlord leads. Use the instant lead generator, contact those seller leads and those landlord leads on there as well. Drive the neighborhood, looking for sale by owners, looking for rent by owners. So those are the best way to get started. Is these top ones right here. Okay. Best and I guess easiest way. And okay, so how do you find these buyers? And the Craigslist is a great way to find them online. Okay, Craigslist is a great way to find them online. So post an ad on Craigslist, and then you can also post an ad on Backpage.com, on Postlets.com. Okay, so Craigslist, Backpage, and Postlets. Those are your 3 primary your 3 primary places there. And I know Julio told me that in Canada, Kijiji is pretty big. Kijiji is not as big here in the U.S., so you still can post there, but it's not. Craigslist is the biggest here in the U.S., and then Backpage is the second biggest. And Postlets is just one of those free tools that allows you to post in multiple different places. Okay. And so you can also use the instant lead generator to send out emails to tenant buyers as well. Okay, you can put out signs on vacant houses, and your sign can say something like $8,000 grant, owner financing, and then your phone number. Okay, whatever the or you can even put generic signs like 3-bed, 2-bath, and your phone number. If you do put generic signs like that, you're going to have many different types of buyers that's going to call you. Some of them are cash buyers. Some of them are buyers that can get a conventional loan. Some of them are buyers that needs owner financing, and some of them are just tenants. And so you can have different types of buyers that that you can do with that. You can also put out a sign that says free $8,000 grant, wide rents owned today, and a phone number. So you get creative with these things and try different texts, have different signs that might work for you. Okay. All right. And then let me see here. You can also put out flyers in that neighborhood as well. Okay, you can put out flyers in that neighborhood. You can send postcard to that zip code if you want. And how you decide what other marketing you can use is based on what responses you get. If the online, if the Craigslist and the Backpage and the Postlist ad is not getting you as many buyers as you want, then you can expand into doing signs. And if that's still not getting you enough buyers, then you can expand into other things like flyers, like postcards, bulletin boards at grocery store and churches, and flyers at grocery store and churches, and so you kind of expand from there. But you will know. For us, most of the time, with just Craigslist, Backpage, and postlets and signs, those 4 things will get us a buyer. So we don't really need to go further out than that. But of course, the more aggressive you are with selling the properties, the better. Okay, the more chance you have of selling them. So it's one of those things where the more is the merrier. So just do more of them. Okay, just do more of them. All right. Again, you can also get a list of non-owner occupant houses in that neighborhood. But this time, instead of sending it to the seller, you send it to the property address. Because if you send it to the property address, chances are it's tenant occupied. And so you'll be able to recruit that tenant to become your buyer. A lot of time when we do these deals, the buyers that we find are tenants that are currently living in that neighborhood, and those are the ones that we find. Okay, these are just redundant here. So here, when you place an ad on Craigslist or even send out emails, this is a good text that you can use. I have a property that I have a house that I desperately need to sell. Okay, and so you kind of give them that urgency, to they think that they think that it's a really good deal. Okay, and so they'll respond to you. Okay, and when you contact these sellers, you're going to offer them owner financing. Okay, and you want to negotiate for. Actually, you should negotiate for at least a 3 to 5 year owner financing deal. Okay, because the 3 years is because the buyer has to stay in there for at least 3 years. So you want to give them at least 3 years for them to be able to refinance. So that way they don't get kicked out, by the seller within 3 years because they couldn't get a loan to refinance and cash the seller out. But if you can get if you can get a longer term, that's great. Especially if you're going to stay in the game. For example, let's say there's a seller. The house is worth $100,000, and let's say the seller owes $80,000 on it. Okay, and so I agree to buy it from the seller for $80,000, and the seller is willing to do owner financing for 3 years. I can then turn around and sell it for $100,000 or even $110,000, and do a 3-year balloon. So that way, if within 3 years the buyer can't qualify for a loan to cash me out, I can then try to find another buyer, and I still have 2 more years left before I have to refinance and cash the seller out or renegotiate with them after 5 years to extend that loan out some more. And so if you're going to stay in the game because there's a decent amount of equity in the property, then the longer you can negotiate with the seller, the better. Okay. And some of the benefits that you want to make sure that the seller is aware of is that they don't they'll no longer have to deal with tenants and leaky toilets because these are buyers, and these buyers will be responsible for all the property taxes, the property insurance, the maintenance on the house. If the toilet leaks, it's the buyer's responsibility. If the AC goes out, it's the buyer's responsibility. If the foundation goes wrong, it's the buyer's responsibility, not the seller. So you want to make sure that you bring these things to their attention. Okay. And then once you get them to agree, you want to control the deal, and you want to control it either as a contract for deed or as a wraparound mortgage, depending on the state that you're in and which one is more favorable. I know for most of you, the contract for deed would be good for you. But here in Texas, contract for deed is not favorable, so we use wraparound mortgage. Okay, and how we get these houses so quickly we do an auction strategy. Okay, we do an auction strategy where we put out a bunch of signs all around that neighborhood. We put out a bunch of signs all around that neighborhood to sell that house that weekend. So we'll do an open house on Saturday and Sunday from 10 a.m. to 5 p.m. and we put out signs. We put out some flyers. We post it on the online classified ads like Craigslist and Backpage and Postlet. And we tell everybody about this. We tell everybody about this property, and this is optional. You don't have to do this if you don't want to. You can also create a website for that property. Like we have one. If you go to homeforauctionhouston.com, we have a property up there, and we put in we put the description on that property and the rules of the auction that you can use and model after that. But we have found it to work just as well without a website, and so the website is not a require. The website is good for the online buyers, so that way they can look at pictures of the property first and understand first before they go to the property. But the signs is what's going to draw you majority of your buyers if you're going to do an auction. Okay, and we put out a lot of signs. We put out 100 to 200 signs for an auction for that weekend. And what we do is we just pick the best buyer, the one with the most down payment that can qualify for the $8,000 tax credit, and that's the buyer that we sell the house to. Okay, so we just pick a buyer with the most down payment. And like I said earlier, all of the closings that we do at title company. And so, once we find a buyer and the seller, we meet up with everybody and get the contract signed and submit all of that contract to the title company, and then they will do all of the paperwork, all of the title search, clear off any liens against the property if they need to, do whatever they need to do to prepare the property and to get it ready to sell. Okay, so that's pretty much it, folks. That's the 7 steps to buy and sell owner financing deals quickly. Okay, so let me take some of your questions here. Kevin asked, why would a buyer need to? Let me see. If a buyer purchases the house in 2010 right now, why would the tax credit go to the 2009 tax returns? Because, Kevin, the 2010 tax return won't be until 2011 because we're just now into 2010. We don't owe any taxes for 2010 yet. So that's why we go back and do the 2009 tax return. Okay. Let me see here. Mark said, just found out about the webinar now. Okay. Let me see here. Judy said, can we use the short email text you provide here on this chart for cold calls to sellers too, instead of taking time to ask them for information about their house first? I don't know why you often use the term apartment, Judy. Most of the sellers you talk to are not people who own apartment. They own single-family homes. But the answer is, can you use the short form? And there's a 2-part answer to that. If you're an experienced person, then yes, you can use the short form to talk to sellers. But if you're a newbie and you haven't done a deal, you haven't gotten a few deals under your belt yet, then I recommend that you use the seller questionnaire form so that you can get used to asking them those questions. Don't worry about taking up their time or yours, but you need to get used to knowing more about their property, and especially if you still need my help or Stan's help to help you analyze whether that's a good deal or not, then you definitely do need get the questionnaire form filled out. For me and Stan, since we're pretty experienced with this and we know very quickly whether or not a deal is a deal for us, so we can skip a lot of the questions that you guys ask about, and we still know what to do with that deal. But for you, since you haven't done any deals yet, it's best if you do ask them as much question as you can, just as a practice, and get used to that until you know how to analyze the property for yourself. Until you know how to analyze properties for yourself, then then you can. That's when you can skip some of the questions. Okay. Judy said rental up here are mostly apartments. Here too, most of the rental properties here are also apartments. However, we don't want to go after apartment. We want to go after single-family homes rentals, not apartment rentals. Okay, and so we want to go after houses or condos or townhomes, but not apartments. Okay, most, if not all of the leads that you find in the Due Deals members area, they're all single-family homes. It's not very often that you'll see apartments in there. So most of the sellers and landlords that you talk to, they own single-family homes or condos or townhomes, but not apartments. Okay. Whew. Man, I need some water. I think I talked straight for too long. Oh, man. All right. Let me see here. Any other questions, y'all? You guys understand it pretty well? You know what to do? Okay. Pretty easy stuff, right? Let me see here. Pretty easy stuff. Make this one smaller. Okay, let me see here. Art asked, I understand that the deadline for the $8,000 tax credit is April 15, 2010. Is there any chance that it will become available later in the year or even next year? The deadline for a buyer to get a property under contract is April 30th, 2010. And the deadline for the buyer to actually close on the property is June 30th, 2010. There is a chance that the government might extend this program again, but we don't know how likelihood of that chance is. I mean, they've done it before, and so there's a chance that they'll do it again, but we can't be certain of that. So it's in our best interest to take massive action right now, and do as many of these deals as we can now. Okay, before the deadline in April happens, and so even if they extend it, great. We'll make more money. If they don't extend it, that's fine. We've made a boatload of money from now until April, and so it's very important for you guys to start taking massive action now. Kevin asked, for the $8,000 deal, do we charge them a fee? The answer is no, Kevin. The way it works is this. Let's say, let's say you agree with the seller to buy the house for $100,000. You're going to then mark up that price to $108,000. So your buyer is actually buying that house for $108,000, not $100,000, and that's how you make your money, is from that markup. So you don't charge a seller a fee for that. Okay. Richard said, yes, 50 calls a day. That's right, Richard. Just take massive action. Call as many as you can. Now is the best time to to do these deals, and so just like put your blinders on, put everything else aside, and just totally focus in on doing these deals. Okay, I mean we only have 4 more months left, and time is passing us by very quickly, and so we need to take massive action to do these deals, because I don't want you guys to come April and then regret that you missed out on it, that you didn't do as many deals as you as you wanted to or you could have. Okay, so take massive action and do as many of them as you can. You know, Mark said, my sellers are just getting back from the holidays, looking forward to gearing back up with them. That's right. Okay. Art said, will you be reposting this webinar again? Yeah, we'll have the replay in the members area for you. Okay. And Kevin said, for the $8,000 deal, how do we get paid? We get paid from the $8,000 markup that we mark up on the property, and we wait for the $8,000 check to come, and that's how we get paid. Do we get paid from the do we get paid the down payment from the buyer? Do we get some part of the $8,000 tax credit? And if we take $8,000 tax credit, then why do we advertise that the buyer can get the $8,000 tax credit? That's a great question, Kevin. Glad you asked that. What it is this. You see, to the buyer, they think that to the buyer, they see that they are buying the house for $108,000, and that the $8,000 tax credit is going to apply toward the down payment of that house. So I'll give you an example. So we're selling the house to the buyer. So we're buying the house from the seller for $100,000. Right? We are selling the house to the buyer for $108,000. Let's say the buyer is going to put $2,000 of their own money down, plus they're gonna get this $8,000 tax credit. So in the end, the buyer is going to owe the seller $98,000 on the house, because they already paid $2,000 from their pocket and $8,000 from the tax credit. So the buyer ended up owing only $98,000 and not $108,000 or $106,000. And so to the buyer, they are the one that's getting the $8,000 tax credit, but they're not getting it to put in their pocket to spend on shopping or something else. They're getting it, and they're using that money as a down payment on the house. Okay, and then that money then is how we make money on it. Julio said, you talk like a politician tonight. No breaks. Okay. John said, is there any info on how to set this up with your own local CPA? Well, you just have to ask your CPA if your CPA knows how to do this. So if they do know how to do it, then the answer is yes. You can set that up with them. So you just have to ask them for it. Preferably a CPA that is investor friendly. Most likely they would know how to do it. Judy said, what if the buyer cannot get the $8,000 tax credit? Well, if the buyer cannot get the $8,000 tax credit, then we can choose not to sell the house to them, or we require them to put more down payment on the house. So let's say they can't qualify for the $8,000 tax credit, but they do have $8,000 of their own money that they can put down, or $10,000 of their own money that they can put down. Then we can use that as well. Okay, the $8,000 tax credit is just additional money, not it doesn't require that we do that way. Kenneth said, if we are able to get a virtual assistant, will they find a buyer and seller for us? They can help you with what they can they can help you try to find a seller and a buyer online for you, Ken. And so what they can do whatever they can online, and you do whatever you can offline. And from both the online and the offline stuff is how you'll be able to do these deals a lot quicker and be able to sell these houses a lot quicker. But the short answer to your question is yes. A virtual assistant can find buyers and sellers for you. Richard said, "Do deals rocks. You guys are great." Thank you, Richard. Thanks for your kind words. Okay, let me see. Art said, "Can you email the map of the 7-step to us?" Sure. We'll email. We're not going to email this mind map out. We'll post it online. We'll post it online, and you can just we'll email you the link, and you can download it. Okay. Let me see here. Judy said, "If the government does not accept the buyer's application for the tax credit, well, the requirement for the buyer to be approved for the tax credit is pretty easy. So we know that up front. There's not a chance that we send in all of the documents and the government deny it. It doesn't work that way. As long as the buyer meets the few criteria that the government has, then we can send it in, and our CPA would know right away, if the buyer will be approved on it or not. But I mean, the requirement is very, very simple, and so most first-time home buyers will be approved for it. All right, Kenneth said, "And will they also be trained on the $8,000 tax credit as well? I am talking about your virtual assistant program, the ones you are training." Well, they are. Some of them watch these videos and these webinars just like the way you're watching them. However, their understanding of it is not that great with this $8,000 tax credit, and so it's better if you know the program, and basically the virtual assistant is just I guess giving you the warm lead of sellers and the warm lead of buyers, but you need to know how to structure these programs because you understand it better than they do. But they do have the same they do have access to training videos just like you do. Their challenge is that they are from another country, so they might not understand the terminology in the real estate as much as you do. Doing the basic things like finding sellers and finding buyers, that's pretty easy, but structuring the deal, that gets a little bit more complicated. A more trained virtual assistant can do it, but a newer virtual assistant probably can't do it. Okay, so you still need to train them. Let me see here. Kevin said, "It seems that all people should at least qualify for the $6,500 second-time home buyers credit, right?" Right. Yeah. Okay. John Hemling said, "Or $5,000 down is good, so you don't lose the deal." Yeah, that's correct. Whatever the buyer has to put down, we'll take it. Okay. Art said, "Can you recommend a good title company, attorney, CPA, etc. in Houston?" The CPA that we use is not here in Houston. He's actually out I think in Kentucky. Okay, the CPA that we use is in Kentucky, but yeah, I can recommend you some attorneys and title companies here in Houston. Art, you just submit that to the hotline for me, and we'll reply to you and with their contact info. Okay. All right. Richard said they're basically your helper. If you don't know how to do the deal, then they can't help. Right, Richard? Okay. Let me see. Awesome. All right, y'all. Well, I am. I'm done. I'm done for today. I got all of your questions answered already, and I need some water. I'm so thirsty right now. But But I really appreciate you guys for being on the webinar, and I enjoy doing this for you a lot. I know you guys. I know a lot of you are thanking me for doing the webinars too, and I appreciate you a whole lot, and so. I'm very happy and very excited to do these webinars with you, and I know Stan also is very happy and excited to do it. And so, Stan and I and our whole team here at Do Deals, it's very important for us that that you become successful in this. We want you to become a customer for life, a member for life, and so your success is very important to us, and we are very committed to helping you succeed. And so much so that today I was able to convince Stan starting next next Monday, to do a daily live. We're calling it Live Deals TV. So kind of like similar to the Happy Hour TV, except for every single day, instead of teaching you guys stuff about mindset, Stan is going to get on the Ustream show and call sellers and landlords and buyers, and whatever deals he's working on, he's going to be talking to sellers and landlords and buyers, so that way you can hear him talking to them. Okay, and he's going to do that from 9 a.m. Central to 10 a.m. Central every single weekday. So right after my happy hour is Stan's show, and that's going to be called Live Deals TV. And that's going to be a really good place for you guys to tune into and learn how to talk to sellers, how to talk to buyers, learning all the intricacy of a deal. We're still going to have these coaching calls. We're still going to have these coaching calls on Tuesday. We're canceling the live sellers call that I have been doing on Thursdays. Because since Stan is going to be doing those seller calls every single weekday already, we figure we don't need to do the Thursday one anymore. So, so we'll just do these Tuesday coaching calls, and then every single day you can listen in on how Stan, on how Stan talks to sellers and work out his different deals that he does. So it's going to be called Live Deals TV, and I'm really excited about that. That's going to be really fun. Okay, and yes, Judy, the shows will be recorded and archived just like the Happy Hour TV show as well. Okay, and let me see here. So make sure you guys tune in for that. Okay, make sure you guys tune in for that. It's going to be a lot of fun, that's for sure. It's going to be a lot of fun. All right, Kevin has another question here, so let me answer this real quick. The $8,000 tax credit comes after the deal closes, right? The answer is right. So the buyer owes us some money. There is some legal document for this to allow us to take the $8,000, right? The answer is right. Yes. Well, the buyer has a promissory note that they owed us for that. We also have a lien against the property, so if they don't cooperate to help us get the check cashed, then technically we can enforce our lien and foreclose on them. So yeah, we do have legal documents that will protect us. Okay, but you guys don't need to worry too much about that. Just take it one step at a time. Just start calling sellers. Okay, do this first part right here. Calling sellers from the Do Deals members area, from the instant lead generator, right? And calling landlords. So start calling those first, and then once you have a flex option, then start marketing for the buyers, and then Stan and I will be here to help you from then on. So, all right. Okay. Well, thank you everybody for being on this coaching webinar. I enjoyed it, and I hope you got great value out of it. So I will see you on the Happy Hour TV tomorrow. I would like to see all of you on the Happy Hour TV tomorrow. Any of you who don't get on the Happy Hour TV tomorrow, I might get mad and tell Stan not to do his show. So that's a way to get you onto the show. Okay. So do get onto the Happy Hour TV. I look forward to having you on that show and have fun with me on that show. If you can't get on the show live, at least watch the replay of that. It's going to help you tremendously in your business. All right, and okay. Good night, everybody, and I'll talk to you on, I guess, the next time I talk to you, either on the Happy Hour TV or on the next coaching webinar. All right, talk to you later. Bye-bye. Good night. Bye-bye.